This week, 5 Mag 7 companies reported earnings. Every single one beat estimates. And the market sorted them into two completely different outcomes. Meta beat by 52%. It fell 8.55%. $158 billion erased on a positive print. AMZN beat by 70%. It fell 6%. MSFT fell nearly 4%. NVDA fell in sympathy without even reporting. Then Google beat by 94%. It rallied 9.96%. AAPL beat its numbers and held clean. That is the same week, the same macro backdrop, the same Federal Reserve meeting 2 days before. 5 companies, all beating estimates, producing wildly different outcomes. If you walked into the week with a simple rule that earnings beats equal higher prices, you paid for it. The question is not what the earnings said. The question is what the chart said before earnings landed. And that is where confluence comes in. Confluence is the intersection of multiple independent technical factors at or near the same price level. Not one indicator flashing a signal. Not a single moving average holding. Multiple unrelated methods pointing at the same level at the same time. Markets are probabilistic. No single technical tool is reliable on its own. A trend line breaks, a moving average lags, a Fibonacci level gets run through. What changes the probability is when several independent methods, each with its own logic, all point to the same place. When structural analysis, dynamic analysis, mathematical analysis and momentum analysis all converge, the setup has a different quality. The market tends to react more cleanly because more participants are using more frameworks that land at the same level. Single-factor signals lose this quality entirely. A stock showing momentum without structural support, or momentum without the right price positioning, can look compelling on one screen and fall apart on the next. There are 4 tiers of confluence, and they do not carry equal weight. Tier 1 is structural. These are the levels the market genuinely remembers. Prior highs and lows. Multi-time frame horizontal zones where price has reversed more than once. Gap fill levels. Round numbers. These levels carry weight because they are visible to every participant regardless of the tools they use. A clean prior high is a prior high on every chart. Tier 2 is dynamic. These are the levels that move with price, the 20, 50 and 200 exponential moving averages. Rising trend lines. Regression channels. Ichimoku cloud boundaries. Dynamic levels shift as price develops, which means when they align with a structural level from Tier 1, the coincidence is significant. 2 independent methods, one fixed and one adaptive, arriving at the same level at the same time. Tier 3 is mathematical. Fibonacci retracements at 38.2, 50 and 61.8%. Fibonacci extensions at 1.618 and 2.618. Measured moves and AB equals CD patterns. These derive purely from ratio and proportion. They have no awareness of the chart's history or current trend. When a Fibonacci extension target lands on a prior structural high from Tier 1 and a 50-period moving average from Tier 2 is sitting at the same level, that is 3 independent methods converging. The probability of a reaction at that level is materially higher than any of the 3 methods alone. Tier 4 is momentum. RSI, MACD, stochastic, volume profile. Momentum tools confirm the reaction. They do not generate the trade on their own. A momentum signal at an isolated level means very little. A momentum signal inside a confluence zone built from tiers 1 through 3 means the reaction is already underway. Building the zone takes 4 steps. First, mark all Tier 1 structural levels on the chart. Second, add the dynamic levels from Tier 2 and note where they intersect or overlap with the structural zone. Third, plot the mathematical levels from Tier 3 and identify the cluster. Fourth, wait for momentum confirmation from Tier 4 before committing capital. The AAPL and Meta split from this week illustrates the difference precisely. AAPL came into earnings with a clean Tier 1 structural level beneath price, a 50-period moving average as Tier 2 support directly underneath, a Fibonacci extension target at the reaction zone as Tier 3, and a volume profile high confirming the level as Tier 4. All 4 tiers aligned. The market respected it. AAPL paid cleanly. Meta had one confluence factor, Tier 4 momentum, a single earnings beat reading. The structural picture did not support continuation. The dynamic levels were not aligned. The mathematical levels were pointing elsewhere. One factor against three absent. The market saw through it, and $158 billion moved the wrong direction for the retail buyer. This is what the week demonstrated in real time. The $500 billion in market cap that shifted this week did not shift randomly. It shifted toward the setups with stacked confluence and away from the single-factor stories. The common mistakes are straightforward once you see the principle. Forcing confluence by selecting only the indicators that agree is not confluence, it is confirmation bias. Stacking four momentum tools does not produce four factors. It produces one factor with four labels. And analyzing confluence on one time frame while ignoring the structure on the time frame above destroys the Tier 1 foundation entirely. The framework for reading confluence properly is available at titanprotect.trade. Daily reads, live calls, and the tool stack that scores each tier of the hierarchy. This is analysis, not financial advice. Always manage your risk.